Hey guys, how are y'all doing? It's Alpha here, and today we're going to go over 4 indicators every day traders should know. Personally, in my experience, I've benefited a lot from these indicators. The reason being is because it gives me some sort of idea as to where to purchase or sell a stock. When you look at these indicators, other traders are looking at it as well. So they have a similar setup where they're looking at these moving averages or the VWAP or even the exponential moving average, and they're thinking, let me see if the buying volume comes in at this price point. So that's what we're going to look out for. I'm also going to show you how I use it in my setup and how it can benefit you as a trader. To start off with, let's differentiate between the two types of indicators. So you have the leading indicators and then the lagging indicators. Leading indicators are those created to precede the price movements of a security, giving predictive qualities. Keyword here is predictive. So you're using this indicator to look into the future, to give you a better prediction as to where the price action will be. One example is the relative strength index, the RSI. The RSI goes from 30 to 70. 30 meaning it's oversold, and then 70 showing that it's overbought. So usually swing traders look to buy at that level of 30. When it's oversold, they look at it as an opportunity to pick up more shares. So they buy when it's oversold, and then when it goes back closer to 70, they sell all their shares for a profit. So that's just one way you can look at it. There's other ways to use the RSI as well, but it simply shows whether a stock is oversold or overbought. Next, we have a lagging indicator. A lagging indicator is one that follows price movements and has less predictive qualities. So it's actually quite the opposite of leading, because the leading indicator gives you a bit more prediction, whereas the lagging indicator is showing what happened in the past. And based on the past, it's using that data to sort of combine it into a way which is presentable. An example of a lagging indicator is the 50 or 200-day moving average. So here's an illustration which simply shows what we just went over. So leading influences future performance and lagging analyzes past performance. The first indicator I'd like to go over is a 50 simple moving average. A moving average is simply the mean of a certain number of data points. The 50-day moving average is calculated by summing up the past 50 data points and then dividing the result by 50. So it's looking at the price action over the past 50 days, adding that together and then dividing it by 50 days. Why 50 days? It's because it's the time frame that we're looking at. So if you have a 20-day moving average, then you're looking at 20 days, but in this case it's 50 days. So it shows the average price that all traders have paid over a given time frame. Now you have the stock price and then you have a certain number of days. So in one day, the price would be different from the next day or even the previous day. Now what this does is it takes the average by combining all the prices and then dividing by the number of days. Day traders use these averages to figure out where to enter or exit a certain position. So if they see that the 50 moving average is at, say, for instance, $5.60, it shows that in the past 50 days, the average is $5.60 for that stock. And over time, these levels actually act as strong support or resistance. There are times you'll see where the stock goes up to its moving average, hits it as resistance, and then comes back down before testing it again and then breaks out of that level and goes for a massive run. That's an example of the moving average used as a resistance level. Once it breaks through that resistance level, a lot more buying volume comes in and then it hits the next resistance level. But the key thing to note here is that it first hit that moving average level because that's what the trader's watching for, simply because everyone's looking at similar indicators. As we discussed earlier, this is a simple formula that shows how an average is calculated. Next is a 200 moving average. The only difference between a 50-day moving average and a 200-day moving average is the number of time periods used in the calculation. So you saw in that formula that at the bottom is the time period, so the range, the period of time that we're looking at. Now, in this case, it's 200. So we're looking at the past 200 days instead of the past 50 days. So the price action would be slightly different. If a stock's been way higher in the past 150 days, previous to those 50 days, then the overall 200 moving average would be much higher. The 200-day moving average is calculated by summing the stock price in the past 200 days and dividing the result by 200, exactly what we just went over. I threw in a few charts just so you have an idea of what it would look like with the indicators. To get a better understanding of how you can use a 50 and 200 simple moving average, let's have a look at an example. So here you can see a chart of CRU. I actually mentioned this on Twitter. I was saying it's holding near 95 cents. If it breaks $1, we can see a run. And this was right before it happened. So I did a U-shaped breakout, came back up to $1. It went for a small run. But the important thing to note here is this simple moving average, which is at just below 90 cents. You can see this break 90 cents. And in fact, it actually broke through 85 cents first before breaking through the second level. So this over here is a 50 simple moving average. You can see this golden color over here and there as well. Then the darker one is a 200-day moving average, which is shown right there at 89 cents. So it broke through this level first before reaching that level, and then it broke through that as well, which shows that it's very, very bullish. The fact that it broke through both of them shows that this wanted to go for a run. And that's exactly what happened. So it ran for 10 cents, sold off, came back to that $1 mark, and then went for another quick scalp to 108 before coming back down. And even when it came back down, it actually crossed below the 9 EMA, and that's something we'll go over in a bit. So these labels simply indicate where there's a breakout or a support. So you can see in this first label, it had the breakout just like we talked about. And then when it went for this run, it sold off and then hit this support level. Where did it bounce off? This level over here, which is the 50 moving average. The third indicator I would like to go over is the 9 EMA. EMA stands for exponential moving average, which means it puts more of an emphasis on the most recent days as compared to the simple moving average. Similar to the simple moving average, exponential moving average puts more weight towards the latest data. It reacts faster to recent price changes than a simple moving average. For that particular reason, it's actually a better indicator of bullish bearish sentiment as it is more focused on recent price action. Now you'll notice that some traders use the 13 EMA or even the 9 EMA. They're very similar, it's just that some stocks follow the 13 better than the 9, vice versa. So if you find that 9 EMA is working better for you, then I'd recommend just keeping that on the chart. But the difference isn't that great, it's very, very similar. Here's an example of how you can use a 9 EMA to determine your entry and exit points. So this red line over here is a 9 EMA. What's important to note is a crossover. So you want to see the area where the stock's going above or below the 9 EMA. So let's have a look at this. This had a red to green breakout. If you watch my other video, you can easily learn what the red to green breakout is. Just to give you a brief idea, it's actually when the stock crosses over where it opened. So it opened over here, did a U-shape, and then broke out this level over here. That's where the buying volume came in and it went for a massive rip. At this very point where this arrow is, you can see that it's above the 9 EMA. Right here, it goes above the 9 EMA, giving a bullish signal, and that's where more traders come in and the price goes all the way up till 450 before selling off. Now it tests the 9 EMA because it finds that as support. So it comes back down, you can see it's trying to hold the 9 EMA before going back above the 9 EMA for a second run, and it broke past the previous high of day at 450. So the 450 break caused this to run all the way up till 480 before the bears took over and brought it back down to 428. So just an overview, when it broke out, it was above the 9 EMA, tested that as support, and then broke out again before coming back below 9 EMA. Last but not least, we have the VWAP. So the VWAP is calculated by adding up the dollars traded for every transaction, which is price multiplied by number of shares traded, and then dividing by the total shares traded for the day. It is the average share price of a stock weighted against its trading volume within a day. Now, if this sounds confusing, don't worry, it's actually not. It's very simple. So it takes into account the number of transactions that are happening and the weight of those transactions. So how many shares are people trading of the stock? And based on that, what should the price be? What should the average price be based on the volume? Institutional investors would like to buy and sell without influencing the market prices with large orders. Now, when institutions are looking at these stocks, they want to buy at a level where they're getting a deal. So they look at the VWAP. What that shows is the average price. So based on a certain amount of volume, what is this stock worth? Because they don't want to overpay, so they'll never buy above the VWAP. And this way it won't disturb the natural market dynamics of stock price. If the stock price is lower than the VWAP, it is a good buying opportunity, vice versa. VWAP acts as support and resistance. So again, you'll notice lots of these day traders, they have VWAP on their charts. The reason is because they're watching for certain levels. So when it goes for a morning run, look at where it finds support. What you'll notice is that it comes back to VWAP, bounces off VWAP, and then goes for another run. Or if it touches support at VWAP, just see if it holds that VWAP level. Because if it doesn't hold VWAP, then that's a higher chance that shorters will come in and drive the stock price down. So that's an important level to look for. Let's have a look at an example as to how the VWAP looks on a chart. This is a chart on GBR. You can see it had this huge run from the red to green breakout, and it was above the VWAP. So right when it had that breakout, this is a blue line over here, just watch this level over here, that's a VWAP. You can see it went right above it and then ripped all the way up till 350, held that level, and then sold off and tested it right over here. So as soon as it came back down, it's important to watch where it bounces, where the support is. You'll notice that stocks fall and fall and fall, but once it bounces off a certain level, that acts as a support. Now, to confirm that support, it has to maintain or hold that level. And then to look for an opportunity, it has to break out of that support level for it to go back to its high of day. But in most cases, it bounces off and then it doesn't go as high as it previously did. So let's have a look at what happened in this case. Bounced off this VWAP support, went back up to 350 before going sideways, and here you go. It's in a channel between the VWAP and 350. So it's going in the sideways channel and it breaks down right here. So this is a key level to watch for. Breaks down below it before coming back up and still holding it. Notice how it's holding this level. So this is a critical time where both bulls and bears are watching this. Bulls want this to come back to 350 so it can break out of this channel and then go for another run. Bears are watching for the break of this, especially that $3 mark, the whole dollar mark, because the break of that could see this come back down to where it originally ran from. That sums up today's video. Hope you learned a lot. I really enjoyed going over those 4 indicators and I hope you can use that in your charts. If you would like to follow me for more information, my social media accounts are right here. So Twitter, StockTwits, and Instagram. Simply search Trade with Alpha and I'll be right there. One last thing I'd like to mention, I recently launched a chat room where I put out live alerts, market commentary, I go over certain tickers. I would love to have you as a team member so we can work on your trading skills and make you daily profits in the chat room. You can sign up using this link and I'll get back to you at my earliest convenience and add you to the chat room and we'll go from there. If you have any other questions, concerns, or comments, you can always reach me at tradewalpha@gmail.com. And once again, if you enjoyed this video, do give it a like and share and subscribe as well for more future videos. That way I get a lot of positive feedback and then I create more videos like these where I spread the knowledge and also help other traders advance their skills.